Hello and welcome to Crypto Weeklies. In this video, we analyze the overall state of the crypto galaxy. None of the content financial advice. This is my website, cryptoweeklies.com. Link on the bottom of your screen. On the homepage, you would see the details about the top 20 cryptos by market cap in this galaxy format. The golden breakout orbit comprises of cryptos which have great momentum and less risk. That is greater than median momentum and less than median risk. Typically, these gems of the asset class at this point, holding the asset class together. Second is the deep accumulation territory, where although the momentum isn't that great, but the risks are lower. And again, how these risks are calculated, how the momentum is calculated is available over here. It looks at the gravity risk and also the market cap based weightings to those time weighted average price based gravity interpretation, looking at the deviation of the price with respect to the time weighted average price, and also the momentum quality using 90-day return and the galaxy status score over here, which is in this middle over here, looks at how high or how low is the galaxy with respect to its own euphoria stage or deep capitulation. Right now it's in a balanced stage. At the moment, the gravity signal, the raw gravity signal, is accumulation, which is, I get, arguably more important to identify what is happening with respect to the state of the asset class. Accumulation is anything which is less than 20% gravity. Galaxy status looks at the zone heat, relative momentum, relative gravity, as well as momentum quality and the 90-day activity. Anything less than 30 is deep accumulation. Right now, the asset class is between 45 and 60, which is in balanced rotation regimen. In this galaxy, near protocol, which is going to be discussed at length today, is the gem of this galaxy. That means the overall scoring with respect to its peers. Near has the highest overall scoring. I know it's not part of the golden breakout, but not always would the cryptos in the golden breakout would be calling the shots or calling the uh, largest attention span in this in this asset class. So near is not in golden breakout, nor is it in deep accumulation. It's in the euphoria stage, which is typically comprising of cryptos which have greater than median risk as well as momentum. M greater than median, risk greater than median. Near, with its great return over the last 90 days in an asset class where even the golden cryptos or the golden um, zone cryptos are down 10%, 12%, 16%, 2%. Near has been up by about, roughly speaking, 50% over the last 90 days or so, and has a decent composite risk as well as raw gravity, and great relative momentum, almost 97, 98%. That means it's one of the leading cryptos in terms of the momentum in the last 90 days or so. Coming to its own analysis, so upon clicking over here, you'll find the deep dive, which has all the laundry list of uh, analytics pertaining to near. We'll start with the phase identification or phase detection model. Right now, since that capitulation to that blue zone, which was typically at those February 2026 lows when the price was at around $1.03, now the price is at $2. Price has now entered the bull expansion phase. The max euphoria target for near is at around $6 at this stage. Looking at how this transpires over the next few weeks to months would be interesting to know. The fair value, mathematically derived regression based fair value for near is at around $1.60. So slightly elevated with respect to the fair value. If there is a correction, then the first area to look for support is this fair value for near. Overall, if we identify the prospects of near with respect to the gravity risk, which is the basis of most of our models, this purple line over here is the time weighted average price. This time weighted average price is one of the more important metrics to judge the phase of the assets journey through the market cycle. That is the crypto market cycles, whenever this price action is suppressed below the purple line, typically in the bear market years, like for example in 2022 till about 2024, and now in early 2025 till about now in mid to late 2026, the risk levels over here helps identify again the risk level one typically looks at the relationship between the price and the time weighted average price throughout its life cycle to identify again where is near with respect to its baseline value. The baseline value is represented by the time weighted average price, and the gravity risk acts like a probabilistic rubber band based on how far can this get stretched to either side. So for example, risk level 8, 9 or 10 stretches the rubber band to the upside, risk level 1 or 2 stretches the rubber band to the downside. Stretch too far, then the price action snaps back to the baseline value, which is at right now at $4 level. When this was stretched at around 96 cents, the propensity of that move was so high that the mean reversion became the likely scenario. The underlying hypothesis is that these assets that we are analyzing do not go to zero. If they were to go to zero, then again, doesn't matter how your time weighted average price chart looks. So accumulating at or near the time weighted average price or in the undervaluation zone helps identify that asset when it is at that stage where it is accumulating at that stage essentially helps beat the clock acquiring the asset below its historical average value. This kind of analysis matters more in the crypto asset class because of the cyclical nature, also the volatile nature of these assets, where from peak to bottom, even in the last season, which was not that great for altcoins. One could argue, if we go back to this chart over here to identify again, one could argue that even despite that lackluster performance to the upside, near did correct from almost $9 to less than $1. So that was almost 90% correction with respect to that peak to bottom. So these kind of analytics help identify again zone out where the risk level has gone up to a territory where typically there is a likelihood to snap back up or snap back down. So this was arguably the more important model after the phase detection model. Right now, the 20-week simple moving average risk has not been that much of elevation, that much elevated. If we were to look for any midpoint related identification, right now the price risk level is at around $2 or so. That 0.5 risk. If it were to go to 0.3 risk or 0.4 risk at the bottom, the targets for near is at around $1.53 to $1.03. The higher end is again if again assuming that there isn't any euphoria this time around in the middle of a bear market, the 0.7 risk level makes the most amount of sense for any major analysis with respect to the uh, with respect to the shorter term bullish target is at around $3 level. The max permissible ceiling is $4.70. Sorry, $4.50. That would require significant euphoria with respect to the price and 20-week simple moving average. So going by that midpoint at around $3 to the upside and $1.53 to the downside is the view in the short term. Looking at the regression based models to identify if the price has if the price action for near has gone to that phase where typically you find some sort of a um, bottoming pattern. So this is the polynomial regression based fair value, the gray line over here. Um, Typically, when the price action is at or um, near the gray line, that's where again at least there isn't any euphoria risk associated with the price action. The dotted red line over here, which is the two standard deviations ceiling drawn from the fair value, has helped historically speaking the 2024 peaks as well as to a greater extent that 2021 and 2022 rallies that near had in the middle of the bear market. So near launched in October 2020, and we're tracking this since that point. At this point in July 2026, the peak regression ceiling for near is $4.33. So that is again confluent with that 20-week simple moving average based euphoria targets as well. So getting at or below that $4.33 would be again would require more than two standard deviation moves, which typically occur in the euphoria phases of the market cycle, typically in the halving or the post halving year. In the bear market year, rallies to this level, these areas above or at that dotted red line come with a greater risk, especially if the rest of the asset class is in the bear market. So where can near go per this regression based target model? If we go by the 0.3 risk level, we are at a $2 level, which is the current spot price for near. The bottom regression floor is at around 76 cents, which is the worst case scenario at this point. The fair value line is $1.60. So going to the regression floor is not the base case every single time. Maybe anything less than 0.1 risk could be categorically a bottom signal. This time around, the price did bottom at around $1 level, which was at close enough at that point to that 0.1 risk. If the bottom is not already in, and then the next target for near, there would be some sort of a cool off in next half of 2026. Looking at that kind of analytics, and that point would require again at least a rally back to the fair value, which at this point is $1.60 level. If price action holds that level as support and it starts building out some momentum from that level, that would be a great thing to see. For near, if there is a double bottom at the end of the year 2026, and the first primary target for near is close to that dollar level, which coincides with that of October 2023 low as well as, and then 3 years later in February 2026, maybe in October, November 2026, that level also gets revisited in the short term. But right now, the overall picture for near is looking really good. Being a gem in the middle of a bear market for an asset class does come with some sort of a, I'm not saying a guarantee, but some sort of a decent prospect for, especially as the asset class were to recover, if the asset class were to recover in late 2026, early 2027 time period. So those positive seasonality once and if and when they were to return back to the asset class, the next targets for near, if we were to look for any macro targets, I know the 68th percentile bear case target to the downside is still at around 95 cents. The 68th percentile bull case target for this particular period is $5. But if we extend this to, let's say, again, we don't know when that bull run will come, but let's say the bullish target for near is a 95 percentile or 2 standard deviation euphoria ceiling for near. That target for near is about $15, which is from the bottom to the peak at around 15x move. I know there is this trend that near has had since the last two euphoria phases, is that in 2022, what moves near could make at around $18 levels. In 2024 and 2025, it failed to do that. I mean, that's not exclusive to near. Most of the altcoins in that 2025 cycle did not manage to go above their 2021-2022 peak. Even for that matter, the 2024 peak in that 2025 negative seasonality. So holding that against near and saying that there wouldn't be any all-time high would be too outlandish at this stage of the market cycle history and the price history. So the euphoria case for near in the next cycle, the first level to look for is at around $15 level, which from here is roughly 7.5x. If we were to analyze this even more further, the indicators that helps that kind of expansions. Estimation of bull target up to 2030 is available on this indicator section. The base peak, as mentioned previously, is $16 in that territory that might conclude in Q1 2030, like it concluded in Q1 2022 for near. At that phase, if we go by our composite risk-based models, the base peak target is about $16. The mid target is $21, which is about 10x of the current price. And the stretch goal is at $29, which is about 14x of the current price. You can also check how this kind of correlates with the rest of the asset performance. How near is holding its own in the last 90 days. Apart from these few names, again, only injective is higher, exhibiting a higher performance than near in the last 90 days. In the last 30 days, I know near did not do that well, but still, over here, if we identify this trend with respect to the, I know it's 50-50 split. Some names are up, some names are down, but near is at least not too negative at this point, at around negative 2.6 in the last 30 days, as well as over the last 7 days. Most things are up, and so is near at this stage with decent rally, about 12% over here. And over the last 24 hours, that's too low to analyze a longer term trend. That also helps again in a different light as well. Near is the crypto of the day with an average bullish rating and average momentum score of positive 14%. We are in, from a seasonality perspective, we have escaped that orange zone, which is typically associated with the Bitcoin season, now in the neutral phase, not in an altcoin territory, which is typically the green zone over here. So it does come with certain risks being in the bear market to mean revert to a Bitcoin only season. But all things equal, if we look for any momentum related cues, right now the bullish seasonality has entered back in the asset class rather than going towards bear case only. So these things, again, if we look from news perspective, these assets are right now in that territory where, again, most of the news are either neutral or slightly have a bearish bias. 19 items over here bearish, 6 are neutral, 4 are bullish of the crypto related content over the last 24 hours. So these kind of analytics help identify again the larger trend. If we were to look for any peak valley identification of the phase of the market cycle, again, even these all assets window over here in a leading fashion has now gone into that accumulation zone with 14%, 15% risk identification. Even the lagging one is close to that accumulation territory. Lagging indicators are also flashing that the asset class as a whole has gone to, if not an accumulation territory, lower end of that neutral zone, which is a good thing to observe with respect to what is happening with respect to the wider asset class. The fear and greed index has now escaped that extreme fear zone to now 27 or shorter term fear. Typically at the end of the bear market, we see that fluctuation with respect to that fear and greed going back to that area. Bitcoin and ETH composite risk is now still in an accumulation territory. We don't have this one for near at this point. This is only for older cryptos which have been around for multiple cycles. So all in all, the status of the asset class being in an accumulation phase, near being the gem of this asset class, hopefully goes a long way as the bear market comes to a conclusion and recovery begins. With that, hope you enjoyed the content. If you did, please give a like and subscribe, and check out all of these charts on cryptoweeklies.com. They are all available for free, no signups required. Thank you and have a nice day. Bye bye.